All right, what is up, traders? What's up, tycoons? Super excited for today's video. We are going to break down TLT, okay, everyone's favorite bond ETF. But before we do so, there's actually a lot of really good information I want to share with you guys, okay? Just taking a look at where the S&P 500, where the stock market can potentially go. We'll take a look at some data from Carson. We'll also look at this Arun signal right here for the QQQ. Bespoke has got some really interesting stuff here about whether or not the market's potentially overbought or oversold. And then Goldman Sachs has a stock watch list. Okay, we'll break down this Goldman Sachs stock watch list and go over a couple of the names in here. But if you want to screenshot this is going to be something interesting. You can take a look at those stocks. All right, one of them is going to be Adobe, and the other is going to be Caterpillar. So one's more tech, one's more industrial. We'll take a look at those. And we'll also take a look at XLU, which is utilities. Utilities have been beaten down tremendously. And when we take a look at the TLT chart in XLU, you can see that they both basically been rallying right around the same time period and had a very strong rally. Both of those obviously are going to be very interest rate sensitive. So as the treasury yields have been, shooting up, things like TLT and utilities were dropping very hard. But now that treasury yields are falling, we're seeing a strong rebound in XLU and in TLT. So I want to kind of highlight the correlation between those. And we'll break down both of those charts in today's video. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. I started a completely free newsletter as well for you called Investment Intelligence, giving out free trade ideas, free valuable trading content and finance content. You can sign up for that using the link in the description. This is what the trade ideas will look like, highlighting the chart. And if you take a look at many of the previous trades from the trade ideas in the newsletter, many of them have played out very, very well. This was one on Stanley Black & Decker, highlighting a rising wedge, showing where the stock could potentially fall down to, and that played out very, very well. Okay, so sign up for the newsletter if you're fans of free, valuable content and you want free trade ideas sent to your inbox every single week. Now, to get access to all of the different trade ideas, I'm still running the Black Friday code. Okay, you can get into the Investment Intelligence Discord for only $1, and this is where you can get access to all of the different trade ideas, not just the free ones that come in the newsletter. Okay, Carnival Cruise Lines was one of those trade ideas, and you can see making over 5 figures on Carnival Cruise Lines. IWM, do you guys remember that crazy day that IWM had, not very long ago? We were actually in IWM. That was another one of the stocks that we were looking at, in the Investment Intelligence Discord. And until Monday, you guys can get in for just $1. So it's basically free. But if you don't want to pay $1, you can still just sign up for the Investment Intelligence newsletter. And that will get you access to those trade ideas, 1 or 2 trade ideas every single week. Now, let's get into the video. And years with a big first half tend to rally late in the year. Now, I've covered many type of melt up charts and explaining a lot of the data behind the melt up theory. All right, and if you're not familiar with a melt up, okay, it doesn't mean melting down. Okay, that's the difference between a melt up and a melt down. I spoke to someone recently about it, and they said, well, I've been waiting for stocks to melt the whole year. And they were confused by what I was saying, right? And so, the melt up is basically going to be a slow, gradual grind up higher. And so if you take a look, right, when a stock is up 10%, when the stock market is up 10% year to date in June, you can see that this yellow box right here, basically the last half of the market, or the last piece of the year in the market, you can see that it just grinds slowly upwards, right? And it has a pretty good performance, right, in that end of the year. And that's where we're at right now. And so this is fueling also the Santa Claus theory, right? There's much data to show that, and suggest that stocks are going to continue to melt up, right? And it's going to be, after this really explosive move, it's going to be hard to just have and continue having such an explosive rally. And so we may see some ups and downs, and it may be, a grind, but I do think it's very possible that stocks can continue to grind higher. Now, this doesn't mean that there can't be bad catalysts that drop the market 1 or 2% in a single day. But the question you have to ask yourself, right, is, will buyers be stepping in and looking to buy those dips, buy those large dips, and continue that grind up higher, that melt up process? So that's definitely, something that I've been, kind of talking about. And we've been talking about the seasonality for September, October. not being too great and how the market typically will find a bottom, within that time period. And that's exactly what we've been doing. So the analysis for seasonality and many different things have been playing out very well so far. Now, this is the Irun signal. I'm not, an expert on this signal here, but statistically, 90% chance basically of an uptrend once we get this signal. And so the signal basically for QQQ has it heading up to above $400 into January. So, that again, it suggests more of that melt up theory rather than a huge crash in the market. It is suggesting basically 90% odds of an uptrend. Okay. And now the uptrend doesn't have to go all the way up to above 400, but that is where basically it is projecting to right now. So that'll be really interesting to see. The QQQ is at 389 right now. So that means, potentially $11 or more of gains left still in the QQQ before the year is over. All right, Bespoke, if you look at their recent morning lineup, they look at, extreme overbought territory, extreme oversold territory. You can see that, coming into November, we were in that extreme oversold territory. And if you notice, there's actually a divergence there. There's been many type of market breadth and market internal divergences suggesting that the market was going to rally. This is basically just another one. And I was highlighting all of those divergences in the videos as they were happening in real time and saying, hey, we're seeing these positive divergences. We should start to see the market start to rally. And of course, it ended up short squeezing, which led to a gamma squeeze, which led to really just, this rapid acceleration upwards in the stock market that we've seen. But if we look right now, we are in that overbought territory. The S&P 500 is also overbought on the daily time frame. So it makes sense for things to cool off. That doesn't have to mean that the market crashes down tremendously. Again, it just kind of suggests that if we start to consolidate, that would be very healthy. That would get us a little bit more out of that overbought territory. And we can potentially continue that grind up, melt up process heading into the end of the year. If you look at the overbought and oversold stocks percentage, okay, green indicates the percentage of oversold stocks. A red indicates the percentage of overbought stocks. About 50% of stocks are overbought right now, and about 6% are oversold. So you can see that, there's very little stocks that are oversold at the market. And we're basically at half when you look at the percentage of overbought stocks. A little over half are overbought at the moment. The market in general as an index is a little bit more overbought because of the Magnificent Seven and the weight that they hold in the market. Those have been rallying a little bit more. And so there are names out there, guys. If you're someone who doesn't want to chase the highs, right? And you see these stocks making new highs, Microsoft is making new all-time highs, and you're saying, man, I really missed that. I should have bought the dip on that. But you're a little nervous about buying all-time highs on a stock. Well, there are other names in the stock market, right? And you can, broaden your horizon. You don't always have to go into the Magnificent Seven. Now, those have been working, all right? And the old saying is, don't try to fix something that's not broken. And so that's not broken yet. It's still been working. But there are other names that you can look at, right? Which is why I bring up this Goldman Sachs stock watch list. There's a high quality sector right here. So there's lots of names in all of these. There's growth stocks with high returns on capital, all right? And then there's beaten down cyclicals. Now, what's interesting is some of the stocks that come in between both of these, right? So if you look at stocks like Google, Meta, Microsoft, those have been performing really, really well. And those are part of the Magnificent Seven. And they're in that high quality and growth stocks with high capital, with high returns on capital. So, you can look at those names. You can look at the names that are in some of these, like Enphase is a growth stock with high returns on capital, but it's also a beaten down cyclical. Utilities are part of that beaten down cyclical sector. All right. And so I just chose two names out of here, in the one name out of the growth stocks with high capital returns. That's going to be Adobe. And then one that is beaten down cyclicals. And we'll just take a look at those charts. But these are some stocks potentially that you can look at, right? And so if we look at Adobe, Adobe has been very, very strong. And a lot of people have been sleeping on Adobe and don't realize how much of an AI play it is. All right. And the reason being is Adobe's got its Adobe Firefly now, which is really amazing. And they partnered with NVIDIA. And you can really see, each time that it's reported earnings and announced these type of things, the stock is gapping up, right? Over here, moving up, over here, moving up. And the stock has just been, performing really well. It's got earnings coming up, so it will be interesting to see. We've seen a lot of stocks sell off, this time on earnings. And we've seen a lot of stocks, rally. What's really interesting is Nvidia seemed to drop the day after earnings. And Adobe and Nvidia, those AI plays, they're very closely related. So it will be interesting to see if Adobe does try to pull back. But the big question is, will buyers be there to step in and buy those dips in the market to potentially, catch that end of year rally, right? And so if we look, there was a huge gap up to fill. Okay, the stock was down here trading below, $280. Right at that 280 range, and there was a huge gap up to fill around 600, and the stock has filled that gap. So the stocks literally ran up over 100%, as many stocks have, but there's still room to the upside here, right? There's a gap up here to about 645, 650, and obviously we're much closer to filling this gap than we are the 1, 2, 3, and 4 gaps to the downside. So there are 4 gaps to the downside. Remember, these gaps, they end up filling about 90% of the time. The big question is when, right? And so sometimes these gaps fill in a very short period of time, and sometimes they take a very long period of time, right? If we look at the beginning of 2022, end of 2021, that's when this gap filled or formed from the 600s. And it took over a year for that gap to fill. And now we're very close to this gap up here, which also formed right around the same time period. And, potentially we could end up filling that gap. Now, again, we have, 4 gaps to the downside. So you do want to be mindful of those. But overall, when we look at the retracement, right? So we have this huge move down. All of these right here, the 38.2, 50%, 61.8, and 78.6, those are your major Fibonacci retracement levels. And when you cross above the 61.8, the odds of a 100% retracement back up here to, the 700s essentially, those greatly increase and go up whenever you are above the 61.8% level. Okay. And we're well above that now. We're above the 78.6. So if this was to pull back and let's say even fill this gap up here right around 550 to 560, okay, the big question is, can we end up holding 537.87? If we can hold and maintain above here, again, those odds of a 100% retracement back up to the previous highs over here, those greatly increase, and basically suggest that there's, a higher odd of us getting back, a higher chance of us getting back up to, those $700 areas. Now, the stock is only about $619 right now. So that leaves almost $80 of potential upside the more we stay above that 61.8% retracement level. If you look here, we also had a clear bearish divergence where the stock was making a high, right? Making higher highs over here. So clearly an uptrend, but the RSI was making a high, lower high, lower high, and lower high. So we had this bearish divergence. And one thing that I try to educate people on in the videos is bearish divergence doesn't always have to mean that a stock has to, crash. You can actually use this as a breakout trend line. And so you can see right here, we actually broke out past this bearish divergence trend line and the stock went on a tremendous rally. And, the RSI broke out here. So if it was to pull back and the stock was to pull back and the RSI was to pull back, we would look for a potential bounce off of this trend line and a continuation up higher, right? So that's Adobe right there. Then we have Cat, which is Caterpillar. So Adobe was more tech. This is going to be an industrial play. And if you look, Cat seems to have had this look below and fail right here. Okay, so we have this major long-term uptrend that we've tested many times, and here, it seems like this was a fake out, right? And the reason that this is so significant is because typically on a breakdown and retest, this is the opportunity for sellers to take control, right? Right here. This is sellers' opportunity to show that they're in control and drive price down lower. When they don't take advantage of this opportunity right here, it shows you that, well, they weren't present. Sellers were not present here, and rather it was a fake out, and there's actually more demand than there is supply, and that's pushing price up higher, right? And so Caterpillar, based off of that, does look more bullish, and we have 271.85 here. That's going to be up near this trend line here. If we continue to progress forward, it's going to be right along this trend line here. And if we break out above there, 290.48 and 320.62 look like some, reasonable price targets here based off of, some fibs and Elliott wave. But I do want to highlight this pattern right here with this initial downtrend and then this aggressive bump down in price. This is one of my favorite chart patterns known as the inverse bump and run. And it's been a very friendly and, nice pattern to me, especially over the past year in 2023. And the way this pattern works out is typically you would break out up to the first trend line and then up to where the past the second trend line and see, it come back up to where the pattern began, which again takes us up near that 290.48 area. If you look at the S&P 500, we actually just completed an inverse bump and run on the daily chart, and now we're back up exactly where the pattern began on the SPY ETF. So, we'll see if this is going to play out in CAT. Now, of course, you do have to always keep in mind the bearish scenarios, so let's say we do actually come back down here and get a little bit of a dead cat bounce and then pull back lower. Well, what would that do? That would actually set up a potential head and shoulders, right? With, a left shoulder being over here, a head, and then a right shoulder somewhere over here. And that could result in us dropping lower and potentially even filling the gap down. There's a gap here just above $210. So, nothing's ever going to be a clear cut buy this and it's always going to go up. You always have to, keep in mind some of the risks. But I just wanted to point out a couple individual stocks, right? And so from that Goldman Sachs watch list. Now, there's a really good watch list right here. You guys can screenshot this, and maybe you're looking for high quality stocks. Maybe you're looking for growth stocks with high returns on capital or beaten down cyclicals, or maybe you want a little bit of a combination of both of these. You can refer to this and look and filter through if there's stocks that you like on a technical or fundamental basis from that. Now, XLU, as I mentioned earlier, XLU utilities are very interest rate sensitive. And so as interest rates were skyrocketing and the 10-year treasury yield was skyrocketing, we were seeing XLU just, completely capitulate. And if we look, we had this long-term zone, right? We had this area of past supply, old resistance many times. Then we broke through, flipped it to support. And obviously the COVID crash happened in the pandemic. We blew through those levels. But if you look, that's where we also regained support and regained demand multiple times in here. So old resistance became new support, and we came down to this zone again, and we found support once again. And this is on a large time frame weekly chart, right? So this zone has been valid since 2017, 2018. It's been an important area of interest for investors. And when we zoom down to the daily chart, we just broke out of this sharp downtrend that we had, broke out, retested that trend line. We're pushing up higher. And if XLU can get above 62, 68, and basically stay above there, if you take a look on the chart, we've tested this level many, many times, right? Especially on a daily time frame. Once, twice, 3 times right here, and then a 4th time again right here, and now most recently a 5th time. So 5 times we've tested that level. The more times you test the level, the weaker it's going to get. So, I do think that even in the short term, this has a good opportunity for a good risk to reward management, where if we're above 62, 68, you can look to target 63.30, or you can look to target potentially the 200-day moving average, which is going to be closer to 64, right? And then you just have a short stop loss right below 62, 68, because we know that's an area that's been strong resistance and we've rejected it 5 times. So it's very valid. And if we remain below there, most likely we're going to continue dropping. Now, there is a small gap down to fill just above $60, right around $60.20. You want to be mindful of that as well. All right. Just in case, we do a little bit of a rejection. All right. Break 61.47 as support. It's very possible that we can come down and fill that gap, if not potentially even head lower and look to retest that demand zone. You want to keep in mind, let's say we fill this gap and continue dropping. All right, keep in mind of this neckline right here, which is basically going to be around 59.50. Okay, that's going to be the neckline for a potential double top. Now, double top is not really confirmed until we break the neckline. At this point, this is just an area of resistance, right? It hasn't actually formed a double top until we actually break through that neckline, at which point it would be a double top versus, a retest of resistance, all right? Now, don't forget, okay, the Black Friday sale is still going on for the Discord. Okay, so you can get into the Discord for just $1 up until Monday. This will get you access to all of the different charts, all the different analysis resources we have available in the Discord. And I'd love to have you guys. It's the first sale that I've run on the Discord, basically giving it away for free. And that has, the Discord's only been around like, 2 months maybe so far. Now, here's our TLT chart, very similar to XLU. It's been rallying here very strongly as of lately. And a large reason of that is because treasury yields have finally been dropping. So as treasury yields go down, something like TLT is going to go up. And we talked about the possible formation of a cup and handle here. And we mentioned how, there's some strong resistance right around 91.03. We've already started to pull back a little bit. Okay. And I'm not saying that TLT has to, crash and reverse. We're just keeping an open mind to the possibility, right? We have a nice cup here forming. And if we were to pull back, we could technically pull back all the way to $85 and it would still be healthy retracement territory. So if we were to do something like that, which there's also a gap down to fill right around $85, if we were to pull back and fill this gap, that's where I would be looking for a potential cup and handle. And that would give us the handle right here that we would need. And if we can rally through that and break out of that, that would put us closer up to our 200-day moving average, which is going to be, slowly ticking down, but it also aligns with a gap up to fill around 96. So the cup and handle, if we do get a breakout on that cup and handle, that breakout would send us up towards this gap fill here up at 96. But keep in mind, there's two other gaps at 98 and one essentially just below 100 as well. And so that leaves still a lot of upside potential. There's many other gaps up to fill on TLT, but those are nowhere near where the price is right now. Currently these gaps are about $10 higher. And we have that one gap down that's about $4 lower. So again, the big question is, will this gap fill anytime soon? All right. Will it take weeks, years, months to fill? It's something you want to be aware of. Maybe you can set some alerts just above the gap fill or right at the top of the gap is something that I like to do for potential short-term trade opportunities where you look for the gaps to fill. Okay, and TLT doesn't have to pull back all the way to 85, guys. It's already started to pull back. The big level that I was really watching was 89.21, and ultimately I'm more bullish above 89.21. Remember, there's three stages to a reversal. You have your downtrend, which we saw right here, and then I mentioned that we were in this box consolidation phase, right? And so box consolidation is going to be phase 2 of the reversal. Number 3 is going to be the reversal itself. And for me, 89.21 was that level. If we can stay above 89.21, even if we just consolidate more here, the odds increase more and more of us getting that reversal that we're looking for. Now, the thing we need to keep an open mind about is maybe that range is extended up a little bit higher. Okay. The stock market, bond market, all these things are ever evolving and you have to constantly update and, redo your analysis. And so, maybe the box right here is going to be 89 to about 82, right? And maybe that's the consolidation phase here. Ultimately, we're not going to know, but 89.21 will be a pretty key level for me. If we pull down below there, 87.94, 86.69, 85.84, and then 85, those are going to be all of the major support levels that are healthy retracement territory to continue an uptrend and potentially put in that cup and handle. If we flip, basically 85 to resistance from support, then the odds increase of us retesting the lows, potentially even making new lows heading down to $80. Now, one thing you want to look for is going to be on your MACD. All right. And so if you look here, this was a bearish MACD crossover where the white line crossed below the red line. The MACD on the daily chart has been a really good signal. So that was a sell signal here. And you can see it sold off very, very hard. Sell signal right here as well on the MACD, sold off very, very hard. And it's starting to curl down. So you do want to be mindful if this MACD crosses below that red line here, that could be a bearish signal, and we could start to see that pullback potentially to that 85, if not lower region. We also have some bullish divergence where we had a low, and we had a lower low, right? So we're making lower lows here while the RSI was making a low, a higher low, and a higher low. That's bullish divergence, and you can see that bullish divergence really helped. Remember, the RSI is going to be a leading indicator, and your MACD is going to be a lagging indicator. So as a leading indicator, that was a leading indicator that we could potentially go bullish and start this rally. And sure enough, it did. And now what we want to see if we can continue to bounce off of this trend line and hold this trend line as an area of support. If we break through, retest, and push lower, that's going to be a potential shorting opportunity right there. and that most likely would coincide with a bearish crossover on the MACD. So, to the upside, we have all of those gaps up to fill all the way up to 100. And to the downside, we know the major support levels. We know there's a gap down to fill. So pay close attention to the MACD and the RSI for any signs of a, sort of reversal in TLT's recent uptrend and whether or not the stock is actually about to start going down. All right, now that wraps up today's video. Don't forget to sign up for the newsletter as well, okay? If you don't want to join the Discord for $1 right now, you can get the newsletter, completely free trade ideas sent directly to your inbox, as well as free valuable finance and trading content. And if you enjoyed today's analysis and you want that, one-on-one touch, and maybe you're more of a one-on-one person learner, you can always book me for a 30-minute or 1-hour session. You just come to my Ko-Fi page. There's a link in the description as well for that. Click on commissions, and there you can book a 30-minute or 1-hour session. You can also request a YouTube video on the topic of your choice, or you can click on this buy a coffee button. That's basically a way to leave a tip or donation for the free valuable content I put out. Thank you guys for watching, and I'll see you in the next one.